Okay, so I just downloaded the screen recorder, so I'm just testing it, and I thought I'd test it on this Robinhood app. Check this out. So, I've watched a lot of videos about people doing their option trading, right? So options are just a derivative of the main stock price. So you can see here the stock price is 103 in the middle of the screen there. So that price is going to go up and down, up and down, up and down. So you can Google the target price for any stock and see what the future forecast. So the future for this is from anywhere from $2 to $5, right? And they're making a lot of money. And their profit went down like 0.01 or something like that. And so right now all your stocks went down. So I wanted to show how to make money kind of safe wise, the safe way. So I'm going to sell a put spread here, a put credit spread, I guess is what it's called. And so you look, so I'm going to sell $1.50 and $1. So as I scroll, what I'm looking for is to see which one went up the most. So that went down, that 1.5. So I'm going to sell a put credit spread of 1.5 and 1 because I believe this stock will go up to 3 this year. Whether it does, it doesn't matter. I'll just roll it out. So here's the deal. So you see that's 45 and 8, but it went down 15% today. There's another one, 50 and 18. It went down 60% and 10%. Here's another one, 9.3% and 20%. Here's another one in July, went down 3.6%. And here's one in January, went up 18%. And here's another one in January 2024. So if I take this one, it gives me an opportunity to roll it out and make some money. So what you do is you click it and you see what the spread is. So it's 80 to 110. That's kind of a high spread, so that means that the previous close was 80. So, and you see what this spread is, 40 to 70. That's kind of a wide spread. So what you can just say, hey, well, let's see what this spread is. That's kind of wide too. So we can look at this one and the one below it, even though that went down. That's too wide of a spread there. So here's the deal. So you look for a stock that has a narrow band spread, and you look for the one that the percentage went up quite a bit. And if you'll get used to this. You'll see it went down 9%, 20%, 16, and you'll see a good standard, right, or a good rate. So then what you do is you find one, because when you're selling options, you want a higher price and you win with time decay. When you're buying options, you want a lower price. So I pretty much only sell options. So I'm selling this 1.5 put, right? So I click the plus, and I could just sell it like that and use money for $150 for collateral. But if I only want to use $50 collateral, I sell them one below it because it's 50 cent or $50 difference there. And you can see my credit is 40 cent or $40, and my collateral is going to be 50. And so the maximum loss is 10, but I'm going to roll that out at least 1 month unless I make a profit really fast on this. So I'm not really going to lose money because I'm going to get 40 now, and then I'm going to get at least 10 when I roll it out. And so you might have to hold it for a while, but when a lot of times, this is a secret they're not going to tell you. Nobody's told you. I watched 1,000 videos on options probably, And nobody tells you. But when you sell an option, and let's say you sell a $100 option and you make $50 on it, or let's say $30. You roll it out and you make another 10. You roll it out and you make another 10. That's $50. Roll it out and you make another 10. And eventually you roll it out enough where you break even just by rolling it. And so it doesn't matter. You're going to make money either way. And so somebody says, well, what if they close it? They're not going to close it. Because when you roll it out, they're waiting to try to either make more. They're not going to close it. You're actually rolling it out to a new person. Long story short, they're not going to close it. And you can just Google why they don't close options early, because they're trying to make as much profit as possible. So then what you do is you look at the graph. Maximum profit's 40. Maximum loss is 10. And like I say, you're not going to lose that because you can close it early, or when it gets close, or you can keep this in your scope. And when you can roll it out and make more than $10, you roll it out, and then you're even. You got your $50 back, and it's just money just sitting there waiting to be made. So review, continue. So my collateral's 50. My credit is 40. So it's gonna, and I'm making money right now, but they're holding 50. So I'm only putting in reserve $10. So at the bottom, sell to open, buy to open. There's a 50-cent difference there, which is $50. But I'm making money. Now there's some special options. I mean, you could probably, let's see what else you could do in this situation. You could probably buy a call down here, or let's say you could actually at the same time you could probably buy a call. You could probably buy. There's a cheap call right there, so you could buy that cheap call. You could buy that cheap call if you wanted to, because if the price goes up, so you could buy that cheap call. It's going to be $18 instead of $10. And let's look at what happens. Now you can roll that call out each month. What's this? So now you have unlimited profit potential. And so as this price goes to, so the price right now is 103. As it approaches the 156, you just start making unlimited money. So let's see how much it's going to cost me now. So I dropped down. Look, okay, so now I'm doing a credit. So now instead of making 40, I'm making 32, but I'm also, because I bought a call, I'm spending the money up front, but they're giving me the money to buy that call through that credit spread. So if the price shoots up, let's say, so I bought what did I buy there? I bought a 150 call. If the price shoots up to $2, that's 50 cents times 100, which is $50. So I can eventually close out this put option early and if I break even, or let's say I make $10 or whatever, you can close it out, leave your call option, but it's a 3 option strategy, so they'll be working together. You can either just close your strategy completely, all 3 legs, or you can close a couple legs. And so there's your you just swipe it. There it is. And so here's the deal. You can do a 3 option strategy, right? You can do a 3 option strategy, and there's options if it goes up, there's options to roll it over, There's options to close out one leg or two legs, or there's an option to close out all three legs, or there's an option just to hold it till it expires. Options are a derivative of a stock, which means off river. And so the option prices are going to move up and down a whole lot faster instead of a stock. Because you saw how much the percentage changes in a day. You know what I'm saying? So if the price changes a little bit, people go crazy, and a lot of times they say, oh, it's getting ready to change. So they go in and buy some, they either go in or sell or buy some, options. So when they start to see a trend, they go crazy and say, I'm going to buy some options, and the price of options can swing. We know that an option's a derivative, so it shouldn't, your delta is a lot smaller. So an option's 1 to 1, but a derivative is like 1 to 0.5 or whatever it is. It shouldn't sway that much, but it does, because people say, oh, I'm going to sell some options because it's getting ready to go up or go down. The delta is a real thing, but at the same time, it goes back to people's belief of a stock going up or down. And a lot of people are gambling. This right here is not even gambling, because I'm only putting out there $18, and I know I can roll it out and I'll make the $18 back. So if you think about perpetuity, you could actually just roll this over in perpetuity, perpetually, forever, and make $10 a month forever. And so if you had 1,000 options, 1,000, and you're making $10 a month in an option, what's that add up to? Add a zero. $10,000 every month, just rolling options. That is the deal right there.